We have not had a webinar in quite a while. And today I am wearing my Naruto Itachi shirt. And for those of you that watch anime, you know it's a show about ninjas. And my kids got it for me, but there is a reason I am wearing this today. We have been bombarded with so much misinformation about what's going on in our real estate market. It seems to be a trend since COVID, we've been bombarded with misinformation, but I'm not going to touch that one. We'll focus on this. But we have been bombarded with so much misinformation that I wore this shirt that depicts a ninja to kind of be a metaphor for how I want to slice through the BS and explain to everybody what is really happening with our real estate market, what is happening now, what has happened with interest rates, and what is going to happen more importantly in the future. And that's the important thing. And the reason the team and I chose today, the day of the interest rate announcement and the day of the interest rate announcement, where the majority of us felt that rates were going to drop, was that even if they didn't drop today and they dropped next month, we kind of know what's going to happen. And we know that based on years and years of precedent of how the Bank of Canada always reacts. And the important thing is not what they're doing, because we know what they're going to do. And we basically know what they're going to continue to do, but what's going to happen and what that means for us, the investor. And there is a small group of us watching this live, but there is a very large group of people that registered and are going to take their time listening to this, rewinding it, and going back and forth. So it is important that I tell you guys what is about to happen. And that's the key. If you're going to really put on what goggles to absorb this today, it's going to be, what do these rate drops mean for us in the future in conjunction, with what has happened leading up to this. So we're going to start off with me talking as always, and then we'll go into the actual deck and we'll go into points and figures. But what we saw the government of Canada adopt some COVID policies that I've always disagreed with. And what I really want to focus on is how we got to inflation and so forth. Well, the government printed more money out of thin air. This government, and I'm not knocking the government, I'm just talking about what they did. They printed more money out of thin air than almost all the previous governments combined. Okay. And anytime you print that much currency, it devalues the currency. And most Western governments operate on the modern monetary theory, which in a nutshell and simplified is, we as a government will print money, we will circulate that money, we will then tax the population and pull that money out of the economy, and there is no inflation created, no devaluation of currency, and no issues at all. This doesn't work. This never works. And we have seen continuous devaluation of our currency, and that's why hard assets as real estate have doubled in value every decade since the 70s. And inflation and the devaluation of a currency started to be documented back since ancient Rome, when they started to put lead into silver coins, etc. And then more of those coins were needed to purchase items because they were no longer pure silver and they were part lead. And that's kind of how it started. And that's basically what happened. And we all knew that inflation was on the forefront. That was an inevitability. So nobody should have been shocked when inflation started creeping up. What we should be shocked is that governments still try to use interest rates and blame our spending as the cause for inflation. There were times when the Bank of Canada and the federal government said that, it was wages that caused inflation. It was our eagerness to pay higher prices that caused inflation. Like, how dare we go and buy food that's expensive when we should go on diets, et cetera, et cetera. And if we can't laugh about it, what can we do, right? But the reality is inflation occurred because we printed too much money, devalue it. And this is a fun fact, and I'm filled with fun facts, right? And for those of you that I talk on the phone with, I have all this knowledge. But in 1930, it cost 10 1 kilogram gold bars to purchase a new home on average. And now in 2024, based on the average home price across the country, it still costs 10 gold bars. So the hard assets are equivalent still after 90 years in value between each other, but the actual dollar amounts it takes with our currency to purchase them has increased exponentially over the years. So that's some food for thought. So basically that in a nutshell is why we're here, to figure out how we can prepare and move forward. And now I've basically talked about what had happened to cause inflation to go up and let us go into this archaic system of raising interest rates to combat inflation, which I do not think works. A lot of people also think it doesn't work. What the raising of the interest rates by the Bank of Canada is supposed to do is curb government spending, because governments in itself spend more than the rest of us, and they are the ones that cause inflation. But that didn't happen. And our interest rate drop now, it has a lot to do with oil prices. Oil prices govern interest rates always in the value of dollars. We are a petrodollar. We're the fourth largest oil producer on the planet. We are tied to the greenback, the United States dollar, which is the monetary choice for the global trade. That's also a petrodollar. And now with a recent announcement by OPEC, the time was right to lower rates. And one more important thing. A lot of people were saying that we could not lower rates if the US Fed did not lower rates. And that was partially true. And I'll touch on that because we should all be fully aware of the background of what has happened. The Bank of Canada in modern times has never done the opposite of the US Fed with interest rate movements. So there is an argument that we don't even need a Bank of Canada because we do exactly what the US Fed did. What we did do, slightly different during this rise of interest rates over the past 18 to 20 months, was we actually raised a little bit more than they did. So we tend to have a spread between our interest rates where we are lower 0.5 to 0.75% than the United States. We recently were only lower 0.25. So the BOC had the leeway and ability to make this first interest rate drop before the US Fed acted, and in turn, it would not affect our dollar value severely. And that's what they did. And the forecast is for the US Fed to drop, and then we will drop. And we are forecasted to have more interest rate drops over the next few years than any other Western economy. And I will talk about that shortly. And according to Benjamin Tal, who is the chief economist at CIBC, I was with him a few weeks ago, and he is a brilliant man when it comes to this stuff. He predicts that we are going to be tapering off around the high 2s to 3% by the end of next year. And we should see 4 interest rate drops this year, bringing us into the 4s, into the 3s, if not 4%. So expect a full point plus drop by the end of the year, which means we're going to have 4 solid drops at least. Okay, so get ready. The market's about to shift, but the market is not going to shift yet. And you guys need to be aware of this. The reason they didn't drop rates in the spring was because our economy here in Canada is very heavily tied to real estate. Okay, and there is a lot of concern that house prices are going to skyrocket once rates come down, and they didn't want to do that during the traditional hyper markets of the spring, and instead by doing it in the summer, and we also have the data which doesn't give them a choice of maintaining them anymore, our CPI is in the toilet. They did it over the summer. They'll do one this month. They'll do one next month. There's no announcement in August. And then by the time the fall market is, they're hoping that the hype and hysteria has subsided a little bit. I really predict that the market's going to pick up in the fall, not yet. But for those of you that have tuned into this live and recorded, I am going to tell you why this is the best opportunity in the next 5 years at least to purchase real estate, and we'll get into that slowly. So let's go into interest rates and media misinformation. This has been my favorite chart for the past 18 months. And it basically shows since 1995 what the Bank of Canada is almost 30 years, how the rate increases and drops of the Bank of Canada have been. And traditionally, we are a one-trick pony here in Canada. The Bank of Canada reacts very, very late to any potential financial crisis. Example, most recent, when the government started printing money like crazy during COVID, the Bank of Canada had dropped rates. But the Bank of Canada only dropped rates because there was an oil crisis and the price of oil tanked. Conveniently, we went into lockdown shortly thereafter. So I'll leave that for another non-webinar conspiracy rabbit hole. But the Bank of Canada crashed rates during COVID because the price of oil crashed. It had nothing to do with COVID. But during COVID, when our government started printing money out of thin air at the fastest rate in modern history, okay, the Bank of Canada did nothing and kept the rate suppressed. That's because the price of oil had tanked. You guys are going to see a common theme throughout this. But when we look at this chart, we see that every time they raise rates, they drop rates quicker to or below the level where they started raising. So I don't know if we're going to drop to near zero again. I do not think so. No one, even including the people smarter than me that I believe are smarter than me, don't think that. But we're going to see rates drop quicker than they were raised. And that is 30 years of precedent backing this up. Now, I talked about this and we need to look at this. This is Bloomberg and this came out yesterday. So this is hot off the press. Touch it and you're going to burn your fingers like a hot potato. So this chart shows the number of interest rate moves implied in an overnight index swap prices for the next 3 years as of June 24th. So what we see here is we see the Euro area, the UK, United States, they're pricing in, the markets are pricing in 6 rate drops for the UK and Eurozone. The United States is supposed to have 7 and we're supposed to have 8. So if we have 8 at 0.25, that brings us to 3%. If any of those is more, we're going to be sub 3. And I'm going to tell you another fun fact, maybe not fun, but every time since 95, when the Bank of Canada and the US Fed has done a significant rate drop, it was on the eve of a financial calamity. So something major happened, whether in the markets, the commodities markets, with oil, etc. Something really bad happened following rate cuts, okay? And us that invest in real estate can find solace in that. During tough economic times, investment leaves other sectors and goes to traditional investment safe zones such as real estate, gold, etc. Okay, so if there is a calamity, which there probably will be because it has happened every other time, real estate is a safe zone. And we also know that the markets and the people smarter than us are forecasting we will have the most rate drops than any other first world G8 nation. And I want you to see here, there were countries that did not raise rates. An example of that is Japan, who just started to raise now. They They had rate hikes. They didn't do hikes previously. They're going to do a couple now. Okay. And China has actually done a rate hike because they didn't raise either because they took a different approach with their economy. So there is always an opposite to what we do. Okay. Misinformation and why it is so difficult to watch the news and figure out what the hell is going on because they send mixed messages. Since COVID, I have been outspoken in saying the news no longer tells us the news. What they do is they sensationalize the news to gain viewership, readership. I don't even know what it's called anymore, but it used to be readership when it was newspapers. But to basically gain viewership, they sensationalize stuff. An example of this, Real Estate Magazine, Canada sees slowest mortgage growth in over 20 years with financial strain growing. Well, of course, no one was buying real estate. CBC, I can't stand them. Report expects Canadian prices to hit record highs in 2026. This actually makes sense. So you have one article saying that nobody's taking out mortgages, no one's buying. The other one saying home prices are going to skyrocket. And that is the forecast. The forecast is we are going to see the height of 2022 pricing by mid 2025, and we will surpass them by 2026. And I'm going to get into this shortly and explain why. Another one, the dirty secret of the housing crisis, homeowners like high prices, 100%. The vast majority of people, their number one investment, their largest investment is their home. Canada's recreational real estate market continues gold rush fever into 2024, despite supply challenges. That is questionable right now. Is it really? Are people really buying cottages that much anymore? Luxury items don't usually get bought that much when interest rates are high. Reality checks Canada housing market isn't out of the woods yet. That's true. It is currently tough times. And I want to tell you guys this. Real estate is cyclical, like most economies. And every 5 years, we usually experience some tough times in real estate, like in 2017. And now we experienced it in end of 22, 23, and now half of 24. Okay. But here's the key. When prices drop, you try to find a way to hold on because they will bounce back. And remember, I said home prices double every 10 years. So if you can hold on to your real estate for about 12 months more, you will be ecstatic, beyond pleasantly surprised. So if we look at some more of these, potential Bank of Canada rate cut would jolt slow housing market. Again, this 0.25 drop, even a half a point drop in July, we're not going to see any real movement in the market till the fall. So mixed messages there. Booming population and plummeting housing starts. This is a really important one. I'm going to talk about it later. We are selling 28% of the pre-construction that we're supposed to be selling. That means in the next few years, 72% less new homes to market. And you don't have to have a PhD in math to understand what that means when it comes to prices, when supply is so little and demand is constantly increasing. That's enough of that. Okay, so basically, filter through the media. Don't get your information just from the media. Rely on professionals. Reach out to me. I'm readily available. I'm sure all of you that have called me, I have answered the phone or replied in a text that I'll call you back and get my opinion. And listen, my life is real estate. You guys know I get hired by brokers to teach them about pre-construction. I created and teach the course at the Toronto and Mississauga Real Estate Board. I am a heavy investor. I had to sell one property this year to create cash flow for an expansion that I'm currently doing. And it was brutal. But I also knew that the other properties that I'm not having an easy time holding on to, it is tough times. I know that because of real estate being cyclical, it's going to bounce back very quickly, and I'll be happy that I held on. So how do you cut through the noise? you read between the lines. So let's look at this article. The federal government is talking about building affordable housing. The federal government's always talking about building housing. But the reality of the matter is the federal government promises a lot and seldom delivers. CMHC's mandate is not just insuring mortgages, but it's also to build homes. In the past 2 years, they built 8 of them. So that's one thing. And I'm not going to really read into this article. I'm going to talk more, but it's just an example. In March, Federal Housing Minister Sean Fraser, who used to be the Minister of Immigration, so he's responsible for all the people coming, but now, we're very undersupplied in houses, concerned a letter to further counterparts noting that it is not realistic for the province to reach 94% of its target in the next 3 years. It is very unrealistic for the province or any government agency to reach this goal. It's the private sector that builds houses. It's not the government sector. And we had a forecast, a prediction of 1.5 million homes being created by 2030 by the federal government. They revised that to 3.1 million. I think that's absolutely ludicrous. We have some of the slowest construction timelines on the planet, and we are heavily focused in red tape, whether it's at the permit phase or the building phase or NIMBYism fighting multiplexes, okay, or neighborhoods getting together and saying, condos are going to block the sun in a playground. I understand. I have kids. But at the same time, it's near impossible to build houses here. And the other thing is, the federal government came out, and again, I'm not knocking the Liberals, but they're really making some crazy forecasts with no track record, okay? And they did get us into this mess, and it's not me being partisan, but the reality is they let in too many people, they spent too much money, they didn't build enough houses. This was all predictable. We've been calling it for years, and now we're stuck in this mess. But they came out and they showed basically prefab, very simple, basic home designs, but they were all houses. So you have half of your population living in southern Ontario, the countries, where land is not in a surplus because we have a green belt around us, where people want to live, there's no available land, and they come out with plans for housing, like actual houses. So where are you going to build this? Like, how are people going to get affordable housing 2 hours outside the city with traffic? How are these people that need the affordable housing going to buy cars to commute to their work in the city? So it doesn't make sense. But anyways, we won't go into this anymore. I just wanted to give an example. Just read between the lines. When the government says they're going to build houses, they're not going to be able to come to close to their forecast, which means we are going to have a further housing crisis, a further housing shortage. And if you have taken anything from the years I've been doing this, I have never steered for my stance that the housing crisis in this country, and especially in Southern Ontario, is just going to get worse and worse and worse. Next slide. Okay, Ontario population predictions. We see a massive jump, and these stats are 2 years old, okay? But we see a massive jump, okay, from around 2020 to 2021, where we saw an increase of about a jump to about 225,000 people. Okay, Ontario's population is projected to increase by 43.6%, or almost 6.5 million people over the next 24 years, for an estimated 15 million on July 1st, 2022 to 22 million by July 1st, 2046. Can you guys imagine what traffic is going to be like? And how imperative would it be for you to own rental properties in areas of high density? Okay. Think of what traffic times are now anywhere in the city. I don't care if you're in the suburbs. I don't care if you're in the core. It is a mess. I have spent a few days of nonstop driving, and I cannot get more than 3 meetings in a day. And that's if I get to start my first one close to 9 o'clock, strictly because of traffic. But let's get back to this. The provincial population is projected to grow rapidly in the short term, increase in an annual rate of 3.2%. That was last year, 2.7% in 23 to 24. and 2.1, 24 to 25. That's right. So we are increasing by 300,000 people a year. And when we talk about Ontario, we need to understand that it is not Northern Ontario. It is basically Barrie South, okay? Golden Horseshoe. And we're getting 300,000 people a year, and the vast majority are coming to the GTHA. Net migration is projected to account for 85% of all population growth in the province from 22 to 46, with natural increase accounting for the remaining 15%. So the vast majority of this, 85% of it, it's people coming in, and it's not us having babies. So wrap your head around that. Now I'm going to talk to you about my jewel in the crown, Calgary, which I love. And the reason I love it is because as Toronto and Vancouver become more expensive, Calgary continues to boom. Edmonton is right behind them. And it's for job growth, it's for opportunity, it's for house prices. And they have the youngest population, working population in the country, the highest paid per capita working population in the country. And I think they're booming. Go Oilers, yes, from Noble. Okay. Now, what we see here is Calgary's metro area grew by nearly 96,000 people last year, a 6% increase in 12 months. Toronto, in comparison, grew at 3%. So percentage-wise, Calgary doubled us and Edmonton at 4.2. That's huge. And although we had more people net migration to Toronto, we're also almost 4 times the population of them. So 100,000 people moving to Calgary is very, very big. And it is booming. And we have a lot of deals by Toronto standards there. And I like to tell everybody that Calgary for me is Toronto back in 2015. And there was a few demographics of people in Toronto that came from very densely populated homelands, and they understood what happened when cities were booming. And they would tend to, a couple groups of people tend to buy a lot of real estate back then. We are, Torontonians are that demographic for Calgary currently because we know what's happening there because we lived it, and we are buying the investment real estate in Calgary right now. So our crystal ball is our experience. It is in recent memory, and the vast majority of the investors in Calgary are Torontonians, and that's why I have bought 2 units myself. That's why we sold close to 100 units over the past 8 months, over the past couple quarters, okay? And we are happy with it. And again, I am not knocking Toronto, but it is much easier to put 10% down on a product that's 50% the cost of Toronto than to buy something here for 20% down when it's twice as expensive. Okay, so Edmonton and Calgary, these are the largest year-over-year increases for both cities in modern stats record, which date back to 2001. And Alberta's recent population boom has been well documented. These figures provide a clear picture of just how many more people are now living in the 2 largest metropolitan areas. And we still have a great opportunity to capitalize this. And Calgary, there's 2 people that are investing in Calgary, and then we'll move on. One is the investor that's always wanted to get in real estate but can't afford the GTHA. There's nothing wrong with that. If you can't afford this market, we have found an alternative that may be even more lucrative for you, okay? And the other one's for people that have established portfolios in the GTHA and they want to invest somewhere else and take a chance. I don't think it's a chance. I think it has very strong fundamentals, just like Toronto's did, okay? Except they have oil, which is a huge trump card. But those type of people are buying here. And if you are one of those 2 people, reach out to us and we will take you every step of the way. And you'll be amazed. You never even have to go there ever for anything. Next slide. Market forecasts. Q3 and 4 2024 into 2025. This is important. Pre-construction sales are the crystal ball to future housing supply. Everybody look at the screen, okay? And Say this either out loud or in your head and repeat it a couple times. Because this is the truth. I know what I sold, my team sold, and my colleagues sold in the past 18 months. And we hardly sold anything in comparison to what we're supposed to sell. So if we, I hate to pat myself on the back or try like as humbly as possible, if the movers and shakers of the real estate world in this country were selling 30% of what they usually sell, that means in the future, 70% less products going to be built. The private sector builds our housing, not our government. Okay? Regardless of what they stand up and preach to us. And if we don't sell stuff, nobody builds stuff. So let's go to the next slide. Read the screen. On average, projects in the pre-construction during Q1 2024 were 50% pre-sold, down from a 61% average absorption level a year ago and 85% 2 years earlier, with pre-construction sales falling well below typical construction financing requirements of at least 70% absorption. Construction starts have experienced a huge decline. In Q1 2024, 2,361 new condominiums began construction in the GTA, down 52%. At the same time, completion surged to a record 12,132 units. These were sold 5-6 years ago. Okay, the construction starts were sold anywhere from a year to 2 years ago. And we only sold 1,461 units. Look at that number. The 10-year average, and we just pick 1 month. And for those of you that don't know, January tends to be a good month for pre-construction sales. It's not the best, but it's a good month. And the month of January is a precursor to the year. So we usually sell 5,000 units. We as an industry sold 1,461. So we are at 28% productivity. That means 72% less sales than expected, which means in the future, because pre-con sales are the crystal ball to the future, in years 2028, which is 4 years, so 2020, late 2027, 2028, and 2029, those 3 years will see 70% less inventory comes to market. 70% less inventory come to market. Think about that. Pre-con sales GTHA expanded. Developers dramatically pulled back on new launches in early 2024 and in 2023 and late in 2022, totaling 958 units brought to market in the first quarter. Think about that. Only 958 units were brought to market in the first quarter. 3 of the 4 projects launched in the GTA in Q1 were in the 905, resulting in an average opening price of new condos at $1,168 a square foot, down 12% from Q4 2023, and a 17% drop from the record high in Q1 2023. Sorry, I had to take a drink. There's a lot of words coming out and even more thinking going on. But what we can see from that paragraph is prices are coming down significantly lower. 4 projects were launched in a quarter. There's usually 200 in a year. Everything is basically in neon letters, pulsating, flashing, telling me there is going to be a supply disaster in the years to follow. An apocalypse supply-wise. There's going to be nowhere for people to live. But when others see problems, some see opportunity. And that's why you guys are here. Go back, please. That's why you guys are here. And that's why we're talking about this. A total of 17,076 units across 56 projects have released marketing materials for an upcoming auction in the next 3 quarters. with a 70% share of units located in the 905. So as prices have dropped, nothing's launching downtown because the land was either assembled or locked in at an expensive price and they cannot sell. So we are going to see new condos, although less of them, a lot less of them, in the years end of 27, 28, 29. The condos that will come to market will be in the suburbs. Downtown, there will hardly be anything. Since the market began slowing in 2022, Urbanation has counted 60 projects to date, totaling 21,000 units in the GTHA that were slated to launch, and Beginner Leaders and Promodio Pro have put their plans on hold indefinitely. That's right. Over 60 projects are permanently on hold because of this, and they might not launch until the end of next year. So does everybody understand my point? We are not going to have any new product coming to market in the future. 60 to 70% less than what was forecasted, with a population that's continuing to increase. And basically, whoever is able to hold on to their real estate or buy some real estate that will come to market and be ready during that 3-year window, that could be a life-changing investment opportunity for us. What does this all mean? Well, I think I covered that, but let's see what the slide says. As pre-sale activity typically impacts construction starts with a 12 to 18-month lag, the slowdown in new condo sales that began in the second half of 22 is expected to continue weighing in on construction for the years to come. Everything that I said in a nice, neatly concise paragraph. When we sell something today, it's 12 to 18 months for it to start construction. There's projects that we sold in 22 that still haven't started. There's projects that we sold in December of 21 that still haven't started. You guys are finally starting to feel what I've been trying to tell everybody, and hopefully I've articulated it well enough. Next slide. The result. And this is my opinion. And again, I'm not a psychic. I am not Nostradamus. These are my predictions based on my experience and the obscene amount of real estate and economic stats that I look at and watch on TikTok and social media over and over and over again. 2024, the real estate market will pick up and activity will skyrocket later this year in Q3 and Q4. Once rates cuts start, which they have, they don't stop for 12 to 18 months. Remember, they drop faster than they raise. Really, September market after Labor Day, we are going to start seeing momentum, and we are going to have, my prediction, the busiest January we've had in years. Rates continue to come down next year in 25. They're going to balance off 2.5 to 3% by the end of the year, with prices expected to, if they reach that number sooner, there's really big problems happening in the world economy. And that's why the governments are doing it. Listen, I want to get into one point. We are one of 2 countries in the world that include interest rates in our inflation calculation, like mortgages and stuff like that. And the other one is the economic juggernaut known as Iceland. Heavy sarcasm on that one. Read into that what you will. But once we start dropping interest rates, our inflation rate doesn't just drop, it tanks, because it's artificially heightened because of interest rates. So when the rates go up, our inflation artificially goes up. When the rates go down, our inflation artificially goes down. So it's like a roller coaster. It's not even a slow train ride, okay? Prices are expected to reach the highs experienced back in 22. I talked about that, with some point near the end of 25 and 26, new highs in pricing across the GTA. So there, CMHC and other think tanks have always been saying for the past little while, for the better part of this year, that expect home prices to double by 2030. We're on track for that. So we're going to see new heights in 26, 27, 28, and doubling by 2030. And then we have one more year, 31, which we can usually forecast 5. And that's where we tend to see another drop in the market. We will be bringing to market 30% of forecasted industry inventory. Remember, I said 70% of what we were expected to sell, we have not. So only 30% of we were expected to build, we will. Starting in 27, 28, as opposed to 60,000 new units coming to market, we're only going to be having about 18. Massive, massive pains that's going to bring to those that have not invested and those people that are renting. Building a portfolio. I am going to take a 5-minute break. I'm going to let everybody absorb that. And then we're going to knock over some numbers that we have talked about in the past. And then we are going to get to some questions. And I am going to tell you what I think you should do at the end for the next half of this year. I do believe it'll change your financial future and your families. So we will be back in, the time is 7:48. We'll be back in 2 minutes. Hello, hello, we're back. Okay, and now we're gonna go over some numbers. And the reason I chose these years, because they were during a boom. And because they were doing a boom, during a real estate boom in our city, I think they're gonna apply for the years to follow, because everybody is forecasting that we are gonna boom like we traditionally do once rates start dropping. They're also forecasting that we're gonna boom due to immense and massive catastrophic supply shortages, which we are going to have. Okay, it's strictly, I don't care who, whether you like real estate, whether you hate real estate. The reality of the matter is, if I sold 28% of what I usually sell, there's going to be 72% less built, and it is what it is. Okay, so that's why we're going to use these numbers, and I think they really apply because they happened at the start of a boom, and they were what experienced during a boom, and that's what we're going to experience. And some of you seen these numbers, some of you has not. We threw in some Calgary stuff. Let's go. Previous investment calculations. Azura Condos, okay. Azura Condos, 15 Holmes Avenue. We bought this in 2019. 749K, 965 a square foot. Initial down payment of 20% was 150. Current new resale in the area, that was selling at about 1250 a square foot. So the proper year valuation of this was a market value of 970. Okay, therefore your gain was 221,000. This was during a boom. This number was actually for back in 20 and during 20 start mid 2023. Okay, so right when the prices started to drop, this is what you would have got over the course of a 4 to 5 year period. Okay, it was an 970 minus 749, it was a gain of 221,000, which is 130% gross return on initial investment. That's just over about 4 years, and 44% year over year return on your investment. Now, these prices have gone down a bit, and I'll tell you why. When the vast majority of condos in our Southern Ontario are purchased by investors. When rates skyrocketed, a lot of people were upside down with their rental rates more so than usual. Okay. And they were having difficulty renewal time and so forth. And we've seen a flood of condos on the market. People are not buying them because the people who would buy these entry level products, they are on the sidelines waiting for rate to drop. So we are in a unique time frame, which only happens with condos about once every decade, because this is the first time condos have actually dropped in a decade. So a lot of people are going to be hating on the condo market currently, but houses have gone up and down like teeter-totter 3 or 4 times in the past decade. Condos have done this once. So this is the first time. So if you bought a condo 10 years ago to a condo compared to now, even with the price drop now, you are significantly better off the fact that you kept it. And I guarantee you, in the fall, we are going to see people start buying these again, and the prices will balance off, and we will see prices start to increase again in the early half of next year. So during the boom, you would have made 130% gross return on this investment in just under 4 years. This is a longer hold. This is if you bought in 2015 and you sold again around mid 2020, late 2022, early 2023. Okay, before the drop, if you bought 600 square foot 1 plus den at 372,000, that's $620 a square foot. This is 2015. This is where Calgary is right now, actually. So this example fits Calgary as well, and it's kind of like a time machine comparison. Current new resale in the area is selling for approximately $1,250. Your 600 square foot 1 plus den of Redpath has a current market value of $750K. That minus your original purchase price is $378,000 gross return. That's a 508% return in 7 years, 72% year over year investment return. These are fantastic numbers, and these are attainable if you time it perfectly. So what we saw basically 7 years of growth because the condo market didn't really drop in 2017 like the low-rise market did. So from 2015 straight up until about really the start of 2023, condos had been appreciating. And that's why it's important to see this, because I always invest in condos because I call condos a necessity and houses a luxury. And luxuries are more volatile price-wise than necessities. So think about it. And what we're selling in Calgary, although we sell low-rise as well, we're heavily focused on the condo market there because as the city's population increase, traffic congestion increases, the ability to move freely throughout areas becomes more tasking. People tend to want to live closer to their work to have a better quality of life. Therefore, the density increases. The future tends to be in density, etc., the need for condos. Next example, Calgary investment calculations. Selling the property before closing is basically selling at closing, okay? So if you purchase, we have 2 bedrooms in the suburbs, $400K, nice round number, but that's their price. It's only 10% down there, so $40K. Market value on occupancy, 6% year over year. These are about 5 years out because there's limited construction crews out there. It takes longer to build. So this is going to be right at the end of our forecast. We're looking at 6% year over year. Toronto, in contrast, was appreciating 8 to 12%. So our 6% appreciation for a city that's actually growing faster than Toronto is a very conservative, even close to 50% conservative. Okay, conservative, 535,000 value of your 400,000 purchase by 2029. It's 135K profit before sale. Sale 63%, 16,000. That's just under 120,000 profit. That's 300% on your deposit in what is it, 5 years? 60% year-over-year growth return. That's big numbers, people. Big numbers. At the height of Toronto, we were getting the same thing, but there's a lot less money down. So the reason I wanted to show you guys is these numbers are attainable. And everybody wants to time the market. And you can't really know exactly when to time the market, but if there has ever been a time to invest based on fundamentals of low supply, low future supply, immigration, dropping of interest rates, now's the time. Let's go over some projects now. We're going to talk about a couple GTA, a couple Calgary. Okay, 1515 Pickering Parkway. For those of you that don't know what's going on in Pickering, Pickering is about to boom. There's over 10,000 units scheduled to be built. It's the next Mississauga of the GTHA. It's going to be Pickering. If you saw a map of what Pickering will look like in 15 years, you wouldn't recognize it. We're basically building a new downtown in Pickering, and condos are synergistic. The more condos, the higher the price per square foot, et cetera, et cetera. And yes, the population growth does require this. We are not overbuilt. I don't care who is going to try to argue that point to you. Just stop talking to them. Don't waste your breath. Spend your time more focused and looking for investment opportunities than talking to people that are doom and gloom. Okay. Launching soon. It's actually unofficially launched today because of what happened with the rate announcement. And we're going to be getting a full package on Monday. I'm going to try to get one for us over the weekend. We're marketing this project and we're getting a lot of registrations. And that's because one beds are starting with the number 4. Not all of them, but some of them, they're starting with the number 4. A year ago, studios started with the number 4. You're getting a proper 1-bedroom unit starting in the 400s. And with what I'm telling you, okay, is going to happen in year 2028 when this will be ready. If 70% less products coming to market and you get a brand new unit with keys in hand, what do you think your rent's going to be like? I was talking to the president who I've known for decades of Savoy, which is part of Fieldgate, who's building this, and there is less than 10,000 units coming to market in 2028. Less than 10,000. And we usually build on average 60. So think about that. All the way to the other side of the city, 1989 Appleby line in Burlington. A lot of people love the West End and a lot of people love Burlington. And we're bringing you 1-beds with parking, again, starting with a 4 in the front. These are massive numbers. Both projects are just over $1,000 a square foot. These are numbers that we haven't heard for 2 years. And this is the opportunity that you guys have now. Another one in Shepherd, on Shepherd, just next to Victoria Park. Okay, so on the Scarborough, North York border, close to transit, close to subway, at the intersection of the 2 busiest highways in the city, the Don Valley and the 401, is 2992 Shepherd. This is for a limited time, is 10% off, and we have 1-bedrooms in the 500s. That's right. Okay, so think about these projects and think about the focus here. You are looking at prices that we haven't seen in over 2 years, with deposit structures that we haven't seen in longer, for projects that are going to come to market and be built when the least amount of inventory ever is coming to market. So if that is not the perfect storm for you to make money, I don't know what is. Go listen to somebody that wants to sell you crypto. Next slide. And my new fave, well, not fave, at par with Toronto, but I thought I would never say that about anywhere else. Calgary, we have 3 projects. One that just started in Southwest Calgary called Yorkville. It's in a subdivision that's basically being created by Mattamy Homes. And Truman has a nice parcel of land where they're going to build 4 buildings, close to 500 suites. This says 2028 occupancy, but expected to be 2029. This is the project that we used an example. The area is called Yorkville. Everybody loves Yorkville. Very different Yorkville than here. Lots of nature on the outskirts of the city. Very peaceful. I own a condo in Southwest Calgary. Great place to raise a family. really beautiful. And that's actually I chose to buy my suburban unit last year. That just launched on Monday of this week. Great opportunities. Reach out to us starting from the 350s. We have Clover, second building is almost sold out. Some great units left. This is on the exact opposite end of the city. So where Violet is on the southwest, this is on the northwest, 300 meters from an LRT line, literally 300-meter walk to an LRT line, just far enough that it's quiet, but close enough that it's ease of convenience. This is, again, starting from the 360s, 10% down, 5% options, better deals with the 10% down, but discuss with us. We'll find the best opportunity. And the jewel in the crown for Calgary, Lincoln. The sister building to Imperia on the other side of the block where I bought my downtown unit last year. So the area is proven by me. I shot a lot of videos in the area that we circulate through social media. It is next to the IBM building on one side, their office building. It is next to the IBM Google think tank building on the other side of the street. So this gives you an idea. Lots of restaurants, walking distance to the Stampede. This building could be in any city in the world, and you would say, what a beautiful condo, but it's coming to Calgary. This is a little bit more expensive. One bed's in the 500s, but there is a huge shortage of luxury condos. And these two buildings, Imperial, where I bought, in Lincoln, are filling a void in a very specific niche. And I guarantee you, you cannot lose at any of these three. Okay. Catchphrase, first Access Condos, don't be second. That is more important than ever. And I know I always quote Warren Buffett. He goes, but when everybody's greedy, be cautious. And when everybody's cautious, be greedy. Now is the time where you guys should be greedy, and you guys should actually think about it and say, listen, if I haven't bought yet, and I know 70% less inventory is coming to market in a few years, and I know that, okay? And I know prices are the lowest I'm going to see maybe ever. And I know deposit structures are super extended. And everything is lining up for me to make an investment. And I know there's a couple of people on this webinar and a couple of people that have registered that have really been sitting on the sidelines for years. And I'm telling you this without calling you out specifically, because there's about 5 of you. I'm telling you guys that this will be the best time for you to jump in off the sidelines, put me in, coach, get into the game, and it's time for you to score. And really, you can't lose right now. You have the lowest prices, the best incentives, and you know that we have sold so little product over the past 2 years that we are going to build so little new product. So you're going to be getting delivery of your product when we will be experiencing the greatest shortage of new housing in our lifetimes. On that note, does anybody have any questions? Kayla?
No, I think we're good to go.
Awesome. Okay, everybody, thank you so much for taking the time to listen to me rant. It is always my pleasure. Again, reach out to us, 437-997-0457. If you want to set up a private call so I can help you fine-tune your investment strategy, it would be the greatest honor for me to sit down and talk to you guys. I know due to traffic constraints, we might not be able to meet in person, but with the wonders of technology, we can Zoom, we can three-way, we can do phone calls, we can hammer out text messages back and forth. But regardless, please really consider this. If you are on the sidelines, it's time to make a move, because in 2030, when we reconvene and we talk again, you are going to be very disappointed that you didn't. Have a wonderful night, everyone, and enjoy the beautiful weather that we're finally having. Cheers.